Welcome to the Daily Update. This is Being Prepared Monday, June 27th, where we'll look at the action in the market today and then see how things look for Tuesday, June 28th. And it was a pretty quiet day. Not an awful lot happened. We saw a really tight range for the day. We didn't really shoot up. We didn't really shoot down. On a positive side, you could say, well, we had some good days last week that are turning things a little bit more positive, and we didn't see a big sell-off today. So that's positive. On the negative side, you could say, well, we started really getting going, looking better late last week. How come we didn't carry that over into Monday? So depending on your point of view, you might see it as a positive or negative day. It did give our charts another day to click forward as far as registering another day. And things are still looking pretty positive overall. We might still be seeing some positive setups, but not a lot was really decided on Monday. So let's go back and talk about what did happen. At the open, we were higher at the open, but selling then quickly took prices negative. And I thought, okay, here we go. We're going to sell into strength, which has been more of the normal pattern in 2022. Anytime we see a bounce, anytime we see some strength, and then something like a gap higher open, even though this wasn't a gap, we did open higher, but not really a gap. We see immediate selling. Well, that didn't last very long. And we pretty much just drifted sideways after that as the day went on. Slightly negative. We kind of hung below the unchanged level for most of the day. Going into the close, we were down 0.31% and volume really dropped off. It was below average. The technicals are still negative overall, but showing some improvement. And the big concern, of course, is what has been the concern for quite a while now: inflation and interest rates, which are producing growth concerns. Different geopolitical events that are going on, positive or negative, could really shake the markets. Earnings as they're released by each company, and we're still going back and forth about, are we going to go into a recession or not? Now we're getting some information this week. We have another estimate on the GDP, and that might help things a little bit, but it's not the final reading. That won't come out for another month. So what are some comments? It was a very quiet day with a small daily range. We never got to R1 or S1. The 10 to the 5 yield curve is still inverted. Fear is still negative, but not extreme negative. We had durable goods that were released, and they was really kind of higher than expected. It increased 0.7% on a month-over-month basis, where they expected it to be up 0.1%. That didn't seem to freak the markets out too much. Our trend is negative overall, and it's weakening because the ADX is really starting to fall a little bit. Our bias, I've switched to positive to kind of mixed because we didn't really see a lot of follow through on Monday. Our momentum is still mixed as well. Even though we're seeing some things under the surface that are positive, we're not seeing it really in the price of the S&P yet. So we kind of have to be a little bit on guard with that. So let's go back and look at sentiment. We're at 29 right now. We're still in the fear category, but not extreme. And here's our chart showing how we were able to come up out of an extreme negative reading recently. This seems to dart all over the place. Over the weekend, I did a video that showed the economic policy uncertainty really dropped. Well, it spiked up on Monday. Here's the GDP now, which conflicts a little bit with the real GDP nowcast. I think that's what they call that. This is released by the Atlanta Fed, and it was updated and showing that we might have a slight increase in GDP for the second quarter, where the other one had more growth suggested. And this was the one that the last time we saw this, it was right at zero. It wasn't positive or negative. Here's some things that I picked up from Isabel Net. The composite index of leading economic indicators, or LEI, it's starting to turn down. Now, this is something that the market doesn't pay an awful lot of attention to, but we still kind of need to heed it anyway. It takes some different indicators or readings from the economy, puts them together, and tries to figure out, are we heading higher? Are we heading lower as far as the economy? And it's starting to roll over a bit. So that could be a bit of a concern. You can see other times when it really started to head down, not long after that, we ended up seeing a recession. In fact, right in here in the 80s, we were already in a recession as this was turning down. The equity fund flow showed that more money went out in the previous week than went in to stock funds. The S&P 500 and EPS, as far as Goldman Sachs is concerned, they're still saying that by the end of the year, we should be at about 4,300. This is an overall adjusted forecast that they've come out with, and they still project earnings to go up. Now, if we do go into a recession, this might change. Then the probability of a recession in the next 12 months, right now, it's reading at about 40-45% or so. And you have a lot of economists. Edward Yardeni, who I'll have some of his charts in just a minute, he's at 40 to 45% that will go into a recession. But you can't rarely get economists to agree on much of anything. And I think the joke is, if you have two economists having a discussion, they end up reaching three conclusions. So it's kind of crazy. And this shows that inflation historically peaks before unemployment. This is the thing we need to keep an eye on now economically, unemployment. We're at very low unemployment right now. We have more jobs available than people to fill them, at least according to the reports that we're getting. Other things that I'm reading say that no, it's not that way. They're outsourcing things. They really are laying off people at different companies. So we're getting a bit of contradictory information that way. But at least according to what is reported and what the market tends to work off of, the unemployment rate is really slow. If we do head into a recession, you would expect the unemployment rate to really go up, or even before we go into a recession. So this is just comparing CPI with the unemployment rate. And it shows here where the unemployment rate has really been dropping as the CPI has really been going up. Here's the other sentiment indicator. They take the AAII, the Investors Intelligence, which I'll show you in just a moment, the put call ratio, the active asset managers, the VIX, and they cram it all together. And they still show that we're over here more towards the left, showing some fear, but not necessarily extreme fear. This is when they ask investors, what do you think will most likely be the reason for the Fed to pause with raising interest rates? And most right now say that the PCE deflator, it drops below 4%. That's what they're thinking is going to happen. Well, we have some of that information coming out, so we want to keep an eye on that. Another thing is, if initial unemployment claims rise above 300,000, that means that a lot of people are being out of work and they're filing for unemployment benefits for the first time. That could really spike up. If the S&P drops below 3,500, well, we're kind of far away from that right now. And then the bond spreads, if they rise back above 500 basis points, that's another reason. And if oil drops below 90. So these are just some different things they ask people, but really inflation is at the forefront of everything right now. The sentiment indicator, it's still negative and not necessarily extreme. That's this dark line right here. We're at negative 1.2. When we get down to 1.5, that's where we're showing a more extreme reading. So this kind of lines up with our fear and greed index. The other index that I just showed, they kind of are all confirming each other right now. Here's the other one too, showing that Investors Intelligence, I got this from Yardeni, it is extreme negative as of the 21st of June. And this is also measuring consumer sentiment. We had that report on Friday that came out that shows people are just not happy at all. And it's showing that overall is the red line, and we're at 50. And my understanding is that's the lowest reading they've ever had for that index. The current conditions, they're not really happy with that at 53.8. And their expectations, are things going to get better in the future? No, they're at 47.5. So people are not only unhappy now, they don't have a lot of hope currently looking into the future. Then here's the unemployment rate with consumer sentiment, showing that the unemployment rate, and this is inverted. Whoops, I meant to flip that back. This is inverted, showing that unemployment is very low, and it also is very low when you compare it to consumer sentiment. And the job openings per unemployed worker, we're almost at 2-to-1 right now. The latest was 1.9. And now switching over to earnings, looking at the S&P ratio, the kind of easier number to see, or the easier line to look at here, the not so dark blue, that's using TTM, that's looking past. When we start with the darker blue line, that's looking forward. And right now it has us at about 17 or so. 20 is considered expensive, 15 is considered fair. So we're kind of right about in between that level right now. The VIX declined even with a slightly down day. Even though we spent most of the day under the unchanged line, we still declined on a closing basis, and we're dropping and staying down below the moving average with the bar. The VIX of the VIX is also really starting to decline. The Ulcer Index is still going up, but possibly starting to roll over. We're down 19.06% since the all-time high. The equity put call ratio, it spiked up a little bit on the one-day chart, but is still declining on the 5-day chart. And this, I just want to bring this up as a reminder, where Dan or Don Byrd put this chart out there, and he thinks that we're right here, that we're coming to the late stages of a bear market, which could be an early recession. Now, when this chart ends, we pick up over here on the other side. And then this just shows how the market will continue to go up after that, because it tends to lead the economy. It doesn't follow the economy. The current Rydex bear bull ratio is at 0.11. Came down just a little bit with the strength that we saw later in the last part of last week. Here are the current pivot levels for Tuesday. And I don't know if this helps you or not. I just put this chart up here. Maybe some of you pause this and look at these different levels. I'm not sure. I use them on my chart, but it updates in real time. And I only use the standard pivot points myself. Here's the daily chart where we're still above this pivot level, and we're right at 3,900. Gee, do you think that's important? This machine gun chart just showing that we're still below what could be resistance, but we're still above what could be providing support. And looking down at the bottom, volume really dropped off on Monday. Here's the same chart with some of that mess kind of removed, where we just see resistance and possible support. We're still above this short-term fib level. This was measured from the high that we made in March to the low that we made back in May. We broke down below that. Well, we've been able to come back above that now, and we're still above that. Here are the daily pivot points that are good, at least for a few more days as June gets ready to conclude. We're still above this retracement level after bouncing back up from the low set in 2021. Here's the other fib chart going from the COVID lows and a low set in 2020, where we're kind of in between support and resistance right now. The weekly chart still shows that the fib level, the 50% retracement, and the 200-week moving average are just about at the same place, but price is still above that. If something happens where we start to fall, we'll want to keep an eye on the 3509, 35 0.08 level. The sectors, the first chart for the sectors just show that discretionary was down the most. Communication, these are some of the things that possibly the smart money is starting to rotate into. Well, Monday was not a good day for them. The sector that did the best was energy, followed by utilities. But these are some things that saw weakness last week. Well, on Monday, they saw some strength, and the areas that saw strength last week saw some weakness. Here's the scooter, SCTR, showing that energy is still first, followed by utilities and staples. These are the areas that have done the best in 2022, where we have communication, discretionary, tech. They performed the worst in 2022, and so their score is a lot lower. This just shows, again, where energy is the best sector, even though it's declined quite a bit, it's still the best sector overall, where all of the other sectors are down since the all-time high. We had some alerts, mostly in the NASDAQ, as it was climbing different levels. The S&P had a MACD crossover, which I'll show you here in just a moment. We had the S&P going above and below 3,900. It ended up registering as going just below 3,900. And I was a little late at taking the screenshot. So this is a 30-minute chart. This is showing where things started Sunday evening, and we were up pretty good. Asia was up pretty good. Europe was up pretty good. And so the futures ended up doing quite well. And then right here where we have the big down candle, that was the open in New York. Here's the intraday chart showing how we had a little bit of a blip up at the open. Then we came right back down. We came up to the unchanged level, went above it for a little while, kind of danced along it, and then spent the rest of the day underneath it. So that means that the pivot levels for Tuesday are going to be pretty close, because they take on this chart, the 10-minute chart, they use the previous day's range to calculate those. Now, that's neither here nor there. I just want to point that out. The ADX is still showing some weakness right now. It's below the moving average. If you're a little more aggressive with this, you think that we're not in a trend right now. The red line is still on top, although it is declining. And the green line is kind of hard to see what it's doing right now, but we're still negative overall. The Arun still shows a decrease in selling, but selling is in the lead, and a decrease in buying. So our oscillator continues to move flat sideways. Breadth, not really much. And you're going to see this in a lot of charts today, just a little turn down based on price and volume. The advanced decline ratio blipped down just a little bit, but is still positive with the blue line, where we're just slightly negative with the red line. New highs, new lows, they're starting to show some improvement. We've turned up with the 5-period simple moving average, and we're turning up with the 10-day as well. Accumulation distribution saw a little bit of weakness, but we're still above the moving average. Short term, if we go back 5 periods with the rate of change, we still overdid it last week, and we haven't worked that off yet. We're still above the 20 periods exponential moving average. And here's our moving average tree showing the same thing. See how far away some of these moving averages are? It's like a distant memory now. Our rainbow, we're trying to stay up into the shorter term rainbow chart. The force index worked off a little bit of an extreme reading on Monday. The Swinland trading oscillator, it's still hanging in there. It's still pointing higher based on price and volume. McClellan oscillator dipped a little bit, although it's still positive. We went sideways with the 20, 50, and 200 moving averages. Stochastics also blipped down a little bit with the short term, still looking okay with the intermediate term, and improving slightly with the longer term stochastics. Intermediate term, we're starting to turn up with the PMO. And you can see we're based on price, we've crossed. We're just getting ready to cross based on the PMO itself. We haven't quite crossed yet when you look at volume. Those PMOs that are rising, we were flat in extreme positive territory. Buy signals continue to improve, and those that are above zero are also turning up slightly. Chaikin oscillator, even though it flipped over a little bit, is still positive overall. Chaikin money flow is just kind of dancing along the unchanged line. We saw a real drop off in volume on Monday. The Vortex pretty much flat with selling, a little bit of increase with buying, but we're still negative overall because the red line's on top. Summation index continues to advance based on price and volume. And some of our oscillators are starting to turn now too. The slope hasn't crossed yet, but could be getting close. The MACD has, as pointed out earlier, but the KST and the tricks, they're longer term. Even though they're rolling a bit, they haven't crossed. The PMO is just getting ready to cross, and the TSI has crossed. So this is showing some improvement. Even though Monday wasn't a real strong day one way or the other, it's giving some of our indicators a chance to recalculate and show some improvement. The BPI came up a little bit, so that's looking better than it was. The rate of change on 50 declined a little bit, and we're still pretty extreme negative. Ease of movement was flat. TTM squeeze. We have a red candle here, but it's starting to come up a little bit. So that's showing some improvement. And we still have this moving average at about 4,000, 4,055 or so that we want to try to get through on this chart. The Heiken Ashi is still looking positive. The Kegi, it's black, so it's looking positive. The other ones didn't change at all. The Elder Impulse remains positive for the SPX and the SPY. And this is kind of a big change. The SAR, you see a dot down below. That has switched over to positive. The go, no-go system is still more of the lighter purple color, so that's more neutral with a negative slant to it. If it turns back to like a light blue or a dark blue, that's more positive. Long term, coming up from the 50, 150, and 200, but we're pretty much flat and didn't do an awful lot of changing on Monday. Rate of change going back, I want to make sure, going back 200 periods, still extreme negative, but remain flat. Here's a longer term look at that same chart. Going back 250 periods, we're also bouncing up slightly. And here's a longer term look at that chart as well. Special K remains in a downtrend. The diamonds are still positive, as are the Qs. And here's the Vixen, even with their erroneous data, where we saw a decline in the Vixen on the bar chart as well as on the line chart. And then here's the other thing that we're looking at, the stocks above their 50-period moving average. After giving us an extreme negative reading, we didn't really move much on Monday, but we're still bouncing up out of that extreme negative reading. Here's the mid caps, the same thing, still bouncing up. And the small caps. If we can see them moving more in tandem with each other, that could be more positive for the market. The dollar, it was down a little over 0.25%, but still in an overall uptrend. Here's the ratio between the S&P and the dollar, almost back to a neutral reading. Oil was up to 109.57, and the ratio, it's kind of bouncing around all over. It's switched more to almost being neutral to a slight inverse relationship. Gold didn't do anything, just down 1/3% with the futures, down 0.11% on the ETF. And here's the longer term look at the gold ETF. Silver was virtually unchanged on the day, even though it had a pretty wide bar. It ended up closing right about at the previous close. And here's the longer term look at that ETF. Bonds, a little bit of a decrease with corporate bonds based on price, a little bit of a decrease in the treasury bonds, about 0.48%. The Pring World Bond Index, after bouncing a little bit late last week, actually showed a bit of a decline, but less than 0.5%. The correlation between the S&P and the 10-year yield is still pretty inverse, but working its way back to more neutral. The tech sector compared to the 10-year yield, kind of the same thing. They're inverse, but working back more to a neutral reading. Here's the 10 to the 5 yield curve, which is still negative. Shows that interest rates went up across the board on Monday. Here's our possible positive scenarios. We're still working off of this idea that once we saw the equity put call ratio, the 5-period version, once it spiked up, it's now coming down, and that could provide some support to the market. Also looking at those percent of stocks above their 200-day moving average, after giving us almost an extreme reading, we're still bouncing up slightly. And here is this same measurement using a different indicator. Here's the divergences that we're looking at, where we actually curled over a little bit with the QQs and the SPY, and we did also with the discretionary and the large cap. So this didn't necessarily help the scenario that we're looking at right now. And kind of the same thing with the growth value based on the large, mid, and small caps. They rolled over a bit. Our trend channel, we're still staying above this dashed line. And the 2-year treasury yield, we spiked up and came back down, but we don't really know yet if this is a valid finished spike or not at this point. And the correlation shows that they still have an inverse relationship, but it's getting more back towards neutral. Seeing nothing on the small cap versus the S&P 500 ratio. We're just not seeing anything right now there. The staples were down 0.25%. And so we're still looking at this, even though the staples spiked up just a little bit, we haven't taken out this high yet. So what's our outlook for Tuesday? The technicals still, in my opinion, are improving with some possible positive setups. Sentiment is not as extreme, but it's still negative overall. We have advanced goods trade deficit coming out, as well as retail inventories and wholesale inventories. We have the housing price index and the S&P Case-Shiller home price index coming out. And then kind of the big one would be consumer confidence. We had the University of Michigan reading on Friday. We get the consumer confidence on Tuesday. Are they in tandem with each other? And then all the different geopolitical events, Russia, Ukraine, the supply chain issues, inflation, interest rates. That's the big focus. If we really start to drop, margin calls, oil, we want to keep an eye on that. Earnings as they're released, any Fed speak that we may come across, the situation in Japan, which is longer term, and then this idea that are we going into a recession or are we not? That seems to be the big debate right now and kind of the focal point. So our scenarios, we're still down overall because of all the things I just mentioned. The technicals are starting to look more positive though. So you might be resistant to go with the down scenario right now. Can you go with the up one? Well, the technicals are improving, but we haven't really switched over positive yet, even though there's a real disbelief that the market is going to go higher. And again, if you go to your YouTube homepage and you watch a lot of videos about the markets, just see what the thumbnails are saying. You know, the worst is yet to come, get set for things to crash, you know, those usual things. If you see a lot of those things, that tends to work as a contrary indicator as well. At least that's the way I look at them. And then we have these possible positive scenarios looking at this idea of sector rotation, but that didn't get helped by Monday's action. And then pivot levels that we're looking at that I pointed out, fib retracements, and then previous highs and lows may provide either support or resistance. We're not neutral right now, but if you're more aggressive with the ADX, you might say that we are because we've dropped below the moving average. So I'll leave that up to you if you want to implement sideways strategies or if you're looking at more trend-based strategies now. So our conclusion is the same as it was. The S&P is negative, but possibly rotating back into growth and showing some improvement. Short term, we're negative, but showing some improvement as well as intermediate term. Long term, we still are negative. So thank you. Have a very good Tuesday, and I'll prepare the next video after Tuesday's session.